Are you making costly mistakes in the stock market? Most investors do. And it could be holding you back from real financial success. Let's break down the top 3 mistakes and how you can avoid them to grow your wealth with confidence. Investing isn't about being the smartest person in the room. It's about discipline and avoiding emotional decisions that sink portfolios. Today we'll uncover the 3 most common mistakes investors make, and more importantly, how you can sidestep them to maximize your returns. Our goal is to cut through the noise and give you a clear, actionable framework for making better decisions. By the end of this video, you'll have practical strategies to help you invest smarter and set yourself up for long-term financial success. So let's get right into it. What you learn today could literally save you thousands of dollars over your lifetime. The first mistake many investors make? It's a common pitfall, one that can derail even the most promising portfolios. It's a siren song that lures unsuspecting individuals into financial ruin. Blindly following the crowd, herd mentality. It's the tendency to mimic the actions of a larger group, assuming that because many people are doing something, it must be the right thing to do. But in the world of investing, this can be a recipe for disaster. When everyone's hyping a stock, FOMO kicks in, fear of missing out. It's a powerful emotion that can cloud your judgment and lead you to make impulsive decisions. You see the potential gains everyone else is talking about, and you don't want to be left behind. You see the headlines screaming about the latest hot stock or investment trend, the social media buzz with influencers and amateur investors alike touting their supposed insider knowledge, and think you need to jump in before it's too late. You feel the pressure to act quickly, to capitalize on what seems like a sure thing. But following the herd usually means buying high, often at inflated prices that are unsustainable. Right at the peak of hype, when the market is frothy and irrational exuberance reigns supreme. Just before the crash, the inevitable correction that sends prices tumbling down, leaving latecomers holding the bag. Remember Bitcoin's surges, the meteoric rise that captivated the world, or meme stocks like GameStop, the poster children for the power of social media and the dangers of herd mentality. Many bought at the top, swept up in the frenzy and blinded by the potential for quick riches, only to watch their investments plummet as the bubble burst and reality set in. Fortunes were lost, and many learned a painful lesson about the risks of following the crowd. The lesson: don't invest just because everyone else is. That's a surefire way to lose money and end up regretting your decisions. Do your own research. Dig beneath the surface and understand the fundamentals of what you're investing in. Become a financial detective. Scrutinize financial statements, analyze market trends, and assess the competitive landscape. Understand what the company does, its products, its services, and its target market. How it makes money, its revenue streams, its cost structure, and its profitability. And whether it has a real competitive advantage, a moat that protects it from competitors and allows it to sustain its profitability over the long term. If you can't explain the business in simple terms, if you can't articulate its value proposition and its competitive advantage, you probably shouldn't invest, because if you don't understand it, you're essentially gambling. Check the basics. The fundamental metrics that indicate the health and potential of a company. Is the company growing? Is it expanding its market share and increasing its revenue? Is it profitable? Is it generating consistent earnings and maintaining healthy profit margins? Does it have manageable debt and strong cash flow? Can it meet its financial obligations and invest in future growth? Assess the management team. Are they experienced, transparent, and invested in the company's success? Do they have a track record of creating value for shareholders? Build conviction through research. The more you know about a company, the more confident you'll be in your investment decision. If the stock drops, you'll know whether to hold or buy more because you understand the underlying value of the business. Instead of panicking and selling at a loss, you'll be able to weather the storm and take advantage of opportunities that others miss. This approach helps you find undervalued opportunities, companies that are trading below their intrinsic value, while others chase hype, blindly following the crowd into overvalued and unsustainable investments. Think long-term investing is a marathon, not a sprint. Focus on building a portfolio of high-quality businesses that you can hold for years, if not decades. You're not just buying a ticker symbol, a meaningless abbreviation on a stock exchange. You're becoming a part owner in a real business, with real employees, real customers, and real assets. Apply the same diligence you'd use if buying a local business. Inspect, review, and understand before investing. Treat every investment as if you were buying the entire company. When FOMO strikes, step back. Take a deep breath and resist the urge to act impulsively. Turn off the noise, the constant barrage of opinions and predictions that can cloud your judgment, and focus on facts, not hype. Base your decisions on data, analysis, and a thorough understanding of the business. Resisting the crowd is the first step, the crucial first step towards building a successful and sustainable investment strategy. To becoming a confident, independent investor. Someone who makes informed decisions based on their own research and analysis, not on the whims of the market or the opinions of others. Stay aware of trends, but use them as a starting point for your own research, not as a substitute. Understand why a trend is emerging and whether it's sustainable. Successful investing is about thinking for yourself, developing your own investment philosophy, and sticking to it through thick and thin. And sticking to a sound, logical process. A process that is based on fundamental analysis, risk management, and a long-term perspective. Do your homework, and you'll be ready to capitalize on opportunities the crowd will miss. You'll be able to identify undervalued companies, avoid overhyped stocks, and build a portfolio that generates long-term wealth. The second big mistake that many investors make, trying to time the market. It's a siren song that lures in even the most seasoned investors. The promise of predicting the market's next move is incredibly tempting. The idea of buying low and selling high sounds great. It's the foundation of investing, in theory. Everyone wants to capitalize on dips and avoid losses during peaks. But even the pros can't do it consistently. Despite having access to sophisticated tools, advanced algorithms, and insider information, professional traders struggle to accurately predict market fluctuations. There are too many unpredictable factors. Geopolitical events, economic reports, unexpected news, and even investor sentiment can all send the market in unexpected directions. Trying to time the market is gambling, not investing. It's relying on luck and speculation rather than sound financial principles and long-term strategies. Most people end up buying high out of excitement, caught up in the hype and fear of missing out, FOMO, when the market is booming, and selling low out of fear, panicking during market downturns, and locking in losses by selling when prices are at their lowest. The truth, most of the market's long-term gains, the kind that build real wealth over time, come from just a handful of the best days. These are the days when the market experiences significant upward surges. Miss them and your returns suffer significantly. The impact of missing even a few of these key days can dramatically reduce your overall investment performance. No one knows when those days will happen. They are notoriously difficult to predict, often occurring unexpectedly during periods of market uncertainty. They often come during periods of high volatility. These are times when fear and uncertainty are rampant, making it even more challenging to stay invested. Instead of timing the market, focus on what you can control. Your energy is better spent on aspects of investing that you can actually influence, your strategy and your behavior. These are the cornerstones of successful long-term investing. Invest with a long-term perspective. Adopt a mindset that prioritizes growth over years and decades. Think in years, not days. Don't get caught up in the daily fluctuations of the market. Dollar cost averaging is your friend. This strategy helps you to buy more shares when prices are low and fewer shares when prices are high. Invest a fixed amount regularly, no matter what the market is doing. This consistent approach removes the guesswork and emotional decision-making from investing. This removes emotion and ensures you're always putting your money to work, regardless of market conditions. Avoid get-rich-quick schemes. These are often disguised as innovative investment opportunities. If something promises high returns with no risk, it's probably a scam. Legitimate investments always carry some level of risk. Build your portfolio around solid companies and low-cost index funds. These provide diversification and long-term growth potential. Remember, it's about time in the market, not timing the market. The longer you stay invested, the greater your potential for growth. The longer you stay invested, the more your money can compound. Compound interest is the snowball effect of investing, where your earnings generate further earnings. History shows those who panic and sell during crashes lock in losses, turning temporary setbacks into permanent financial damage, while those who stay the course are rewarded. Market downturns are a normal part of the investment cycle, and historically, markets have always recovered. Patience and discipline are your greatest assets. These qualities will help you navigate market volatility and stay focused on your long-term goals. The market will test you with volatility and downturns. That's normal. These fluctuations are an inherent part of the investment landscape. Your success depends on your ability to endure, not predict these moments. Staying calm and sticking to your strategy is crucial during turbulent times. When you feel the urge to react emotionally, remind yourself, take a step back, breathe, and remember your long-term objectives. You're a long-term investor. Your investment horizon extends far beyond the current market conditions. Trust your strategy, ignore the noise, tune out the constant stream of market news and opinions that can cloud your judgment, and focus on building a robust, all-weather portfolio. A diversified portfolio can withstand various market conditions and provide more stable returns over time. Abandon market timing, embrace discipline, and commit to a consistent investment approach, and you'll dramatically increase your odds of reaching your financial goals. A disciplined, long-term approach is the most reliable path to financial success. It's less exciting, but far more effective. Investing for the long term may not be as thrilling as trying to time the market, but it's a proven strategy for building wealth. So what's the third critical mistake that new investors often make? It's a pitfall that can decimate your portfolio if you're not careful. Overexposure, putting all your eggs in one basket. This is when a significant portion of your investment capital is allocated to a single asset, sector, or even a specific geographic region. Many new investors, fueled by excitement or a strong belief in a particular company, fall in love with a single stock or sector and go all in. They might hear about the next big thing, a revolutionary technology or a booming industry, and decide to concentrate their investments there. It feels great when it's going up, the returns are amplified, and you feel like a genius, until it isn't. The market can be fickle, and what goes up can just as easily come crashing down. If that one company or sector crashes, due to unforeseen circumstances, market corrections, or simply a change in investor sentiment, your entire portfolio can be wiped out. The consequences can be devastating, especially if you're relying on those investments for your future financial security. Remember Enron, once a darling of Wall Street, WorldCom, another seemingly invincible giant, or the dot-com bubble, which erased billions of dollars in wealth almost overnight. Overconcentration destroyed countless portfolios, leaving investors with nothing to show for their hard work and savings. These are cautionary tales that highlight the importance of diversification. The solution? Diversification. It's the cornerstone of sound investment strategy. Spread your investments across different assets, industries, and geographies. Don't put all your faith in one single area. Diversification reduces risk without sacrificing returns. It's about building a portfolio that can withstand market fluctuations and economic uncertainties. It's often called the only free lunch in investing. You get a significant benefit-reduced risk without necessarily giving up potential gains. Own a mix of stocks, bonds, real estate, and maybe commodities. Consider alternative investments as well, but only if you understand them. When one asset falls, another may rise, helping to cushion your portfolio against significant losses. This is because different asset classes tend to perform differently under various economic conditions. Within stocks, diversify by industry and company size, large cap, mid cap, and small cap. Each category offers different growth potential and risk profiles. Don't limit yourself to your home country. The world is a vast and interconnected marketplace. Global diversification gives you access to growth worldwide and protects against local downturns. If your home country's economy is struggling, your international investments can help offset those losses. The easiest way to achieve broad diversification? Low-cost index funds or ETFs. One S&P 500 fund gives you exposure to hundreds of companies, representing a significant portion of the U.S. economy. Add international and bond funds for even broader coverage, creating a truly diversified portfolio. Once your portfolio is built, review and rebalance it periodically. This is a crucial step in maintaining your desired asset allocation. As some investments outperform, your allocation will drift, meaning your portfolio will no longer reflect your original intentions. Rebalance to stay on track. This involves selling some of your winning assets and buying more of your underperforming ones. Rebalancing means selling some winners and buying underperformers, a strategy that can feel counterintuitive but is essential for long-term success. Keeping your risk in check. It prevents you from becoming overexposed to any single asset class. Aim to review your portfolio once a year or when allocations drift significantly. Market fluctuations can quickly alter your asset allocation. Don't chase the illusion of safety and concentration. It's a dangerous game that rarely pays off in the long run. For every big winner, there are countless losers. The odds are simply not in your favor when you concentrate your investments. Long-term investing isn't about home runs. It's not about trying to get rich quick. It's about steady, consistent growth, building wealth gradually over time. Diversification is your best defense against the unpredictable nature of the market. It's a risk management tool that protects your capital. Build a resilient portfolio that can weather any storm, from economic recessions to unexpected global events, and compound over time, allowing you to achieve your long-term financial goals. Don't let a single bad bet ruin your financial future. Protect yourself with diversification. Make diversification the bedrock of your strategy, and you'll be well on your way to building a secure and prosperous financial future. So there you have it, the 3 most common and costly investing mistakes. Each is rooted in emotion, not logic. By understanding and avoiding them, you're already ahead. The key to long-term success? Master the fundamentals. Do your research, stay invested, and diversify. These principles aren't glamorous, but they work. And they're the foundation of real, sustainable wealth. Take control of your financial future. Build a strategy that lets you sleep well at night. Subscribe for more investing tips and share your own lessons in the comments to help others. Invest wisely, stay informed, and your financial journey will be a prosperous one.